or rather Adar Poonawalla. That stock has been an outperformer. South Indian Bank has raised money, so that stock also is getting a little bit of green.
Eveready is up 3%, so that one is in the news as well. So that one is showing some traction there. But let's do one thing. For now, the selling pressure has been arrested to 250 points. Mitesh is still with us. Mitesh, how would you approach it? It's about 14,850 right now, and it's not gotten worse. What do you do now?
See, I think, the Nifty index, the Bank Nifty index, and I would add a Nifty IT to it. I think all the three are looking negative on the short to intraday chart. So I think trading should be more on stock specific basis. I would want to go short in a couple of IT names and on the opposite side, I think buy into Reliance and Coal India, which is what I have been maintaining for the last couple of days.
Okay. Thank you very much, Mitesh, for joining us with all your trading strategies. We'll touch base with you later. The Nifty Bank is the one that is in deep pain. That's now down 3%, which is over 1,000 points lower. And of course, the Sensex also is about 1,000 points lower, 2% down in that index. The breadth was as bad as almost 5 in the red for 1 in the green. Now it is 4 in the red for 1 in the green. So market trying to find its feet around that 14,800 mark. Let's invite our market master for the morning, Sanjay Mookim, strategist, head of equity research at JPMorgan. Good morning, Sanjay. Thank you very much for joining us. We are meeting on a troubled day, but tell us how the pattern is likely to be. Are we going to see such sharp corrections because of what the bond market is saying? Would these dips still be attractive buying opportunities?
Good morning, Lata. Great to be on. On the last part, that is our house view, that any major correction, any wobble in the market continues to be buying opportunities for equities, not just in India, but globally. Our view is that, look, we've seen these spikes in bond yields in the US yesterday, hitting 1.6% at some point. When the bond yield settles down, we'll go back into a market that continues to drift up, supported by this huge flow of asset purchases by the central bank. So the one comfort that everybody has is that central banks will continue to buy assets at a very great pace for the rest of the year. And that should, like I say, underpin continued equity market upside for some time. The last point I'd add here, Lata, is that we've argued in our research as JPMorgan that even if the bond yield goes up to 2 to 3% in the US, it doesn't really call for derating of equity PE. Because even now, equity yields are much higher than bond yields, so that spread is much higher than average. So equity markets can absorb and live with slightly higher bond yields still.
Is this a time, Sanjay, to be buying value stocks more than growth-oriented stocks? I mean, I'm asking because the trend so far this year has been that, right? We've seen a big recovery in so many PSU names, so many beaten down pockets. How are you approaching it?
Well, the medium-term expectation or suggestion from us, of course, is to continue to focus for growth-oriented companies. And the reason is, again, looking at the bond market and the expansion of liquidity, as the opportunity cost of capital falls, you will see growth getting discounted better, right? And growth stocks will continue to do well as the bond yield stabilizes. Of course, when you have a period when yields are going up, value will outperform growth. But this is not a permanent outlook for us for the rest of the year. And therefore, when it settles down and when the bond yield finds a level that is acceptable, we think the market shifts back to looking at more growth in terms of and not value.
Okay. Sanjay, there has been a lot of IT sell-off, obviously because NASDAQ is correcting. Would that form a part of your strategy to buy them in these dips?
Well, look, Lata, the Indian IT and the IT that you refer to globally is completely different, right? Indian IT, sorry, these are services companies and they don't necessarily move in lockstep with the global NASDAQ sort of sentiment. But it actually goes back to the growth versus value debate that we were having earlier. As yields are rising and as people are looking at higher cost of capital, you are seeing growth here stock, which are typically the technology names, correct in valuations. But once it settles down, my sense is that market focus will shift back to discounting longer-term growth names.
Okay, in the last 1 year, people have made money hand over fist in the mid-caps and small-cap stocks, especially many of the quality names, many of the digital plays, the home improvement spaces. Is that strategy going to change, or do you think that it's still worth buying mid-caps compared to large caps?
Well, look, Sonia, there's always an argument for buying a company that you like, right? So if it's a small company or a large company, doesn't matter. If there's good execution in a good business environment, you should buy that stock, right? However, as a theme, we've been arguing for India, and this is where our outlook for the economy comes in, that mid caps and smaller caps are likely to underperform through the back half of this year. And the argument being that the Indian economy, which has delivered great V-shaped recovery and rapid bounce back from the COVID lows, is likely to stagnate a bit for the next few quarters. Right? There's not much of reopening trade left in India. And when you have broad-based economic slowdown or weakness in activity, then smaller companies, or let's say fewer companies, will end up surprising on earnings. Right? And ultimately, it's the earnings surprises that drive stock prices. So our sense is that market breadth in general should narrow getting into the back half of this year.
Okay. Sanjay, will these episodes be frequent? The bond market throwing a tantrum and hurting equity markets?
Well, let me say this, Lata. I don't know whether it will be the bond market tantrum or something else or not, but you should continue to see through the year some reason for volatility spikes every now and then, right? We had, concerns on the COVID second wave a little bit earlier in the year. Now it's the bond market. It may turn out to be something else, maybe geopolitics, who knows? But you can see these volatility spikes, which causes market flutters, but these should not persist. Given the wave of liquidity, it's $300 billion a month of purchases between the Fed and the ECB. I think these will get dampened out and the market should continue to rally, or like I say, continue to drift up through the year.
Okay. They generally say, if you're looking for quality names and you get a 10 to 15% dip, then one should buy into them. I was looking at some of these, say, paint companies, for example. Asian Paints has gone from about 2,800 now at 2,300. Should that be your approach, that look for market leaders, look at where stocks have about 10-15% dip and buy into them now, or should the approach change a bit?
So Sonia, we can't comment on single companies, and I won't, respond to that one name that you referred to. But I would say that as a framework, this is a tried and tested method of making money in equity markets. If you have patient capital and if you get a good management team in good business, and you have that 2-3 year view, these corrections always or invariably tend up being buying opportunities. You tend to make money when you do this kind of investing.
Okay. Sanjay, if say you got an incremental $100, what would you advise an investor to put in? Would it be more the banks, more the cyclicals?
No, so Lata, we are very focused on the banks now. And our principal argument, which has been for some time, is that in the economy that is still kind of trying to find its feet post-COVID, companies or businesses that are able to deliver growth are the ones that will outperform their peers. Okay? And banks, in their ability to drive their own growth, kind of stand apart, right? Because it depends upon the bank management's appetite, the credit risk they're willing to take. The ingredients are all there. They have capital, they have liquidity, they have low cost of funds now, at least the larger banks do. So if they are willing to press on the accelerator a little bit, it is possible that the banking names deliver growth better than the rest of the market through the rest of the year. And that is why we say that, look, of that 100, as you said, Lata, a principal portion should end up looking at the top 4-5 banks in the country.
And the
However,
least,
there is a cyclical...
And the least should go to?
Consumer discretionary, right? If I'm going to stand out from the crowd saying that a bit, our worry on the discretionary pack, which has been for some time now, is that the top line expectations from these names are very robust. People are straight lining the growth that we've seen and assuming very continued growth through FY22. That is unlikely to happen. And of course, commodity pressures, while you can talk about the commodity companies, affect the consumer companies negatively on margins. Okay, so both on top line and on margins, there's concern on the consumer discretionary names.
Okay, I was going to ask you about the commodities, but before that, before I forget this question, the current bond yield spike gets compared to both 2013 taper tantrum or 2003 when it was actually the harbinger of growth. If you want to draw comparisons, what would you draw?
Well, at the moment, Lata, it looks like this is growth driven. And this is simply because, look, we are upgrading even ourselves global GDP forecast. So we've gone from, let's say, 4.5% for CY21 to 6% GDP growth now. And now we have an outlook with the enhanced stimulus in the US that the US is going to outperform the rest of the world in economic recovery this year. So a lot of the bond yield movements we're seeing today is because there is this worry that economies may be running super hot, which is something rare we've not seen for quite some time.
Yeah.
Okay. I just want to come back to the earlier point you made about, some of these consumer spaces like autos, etc., that you don't like too much. This is a space that has done quite well, right? So many of these stocks like Bajaj Auto, for example, is sitting at a new high. There is recovery in demand for sure. And now with rising COVID cases, once again, personal mobility will come back into fashion. Don't you think that this could be a space to be in for the medium term?
Yes, so Sonia, I'd say for many, and again, I won't respond to that name, but for many of these stocks in the consumer discretionary category, there is a debate on time period, right? So if you're looking at the next 3, 4, 6 months, I think these companies will struggle a bit to contend with the rising input costs, whether they pass on the prices or not. Plus, I think the top line momentum is likely to slow for a broad range of discretionary names. However, the positive outlook, and especially if you say medium term, and I'm assuming that's like 12, 16, 18 months, lower interest rate phenomena in India, the monetary stimulus is very strong, right? Real interest rates are negative and nominal rates are the lowest I've seen for quite some time, right? Lending rates for autos or mortgages are very, very low.
Absolutely.
And historically, this has driven demand over time. With a lag of about 12 months or 16 months, you do see the lower rates driving top line. So the hope is that the surprises in the discretionary names start to creep in because of this monetary stimulus. We just need to wait and see for this to happen. Until then, I'd be a bit careful.
Okay. All right. Point taken. Thank you very much, Sanjay, for joining us with both a comprehensive macro view and your sectoral preferences and reasons. Have a great weekend if the markets will allow you to enjoy.
Likewise. Have a great day.
Okay. Well, among the